We haven't bought a building, by the way, in 3.5 years. That's a pretty bold statement. We're a real estate firm, with $5 billion of assets. I haven't bought a building in 3.5 years. I'm like, wow. Why? Well, because we thought valuations were too high and not sustainable. Am I ready to start buying now? Not really. I think it's getting closer, but I literally had a lunch today and someone said, well, are you ready to buy? And I said, not yet. I mean, leverage is negative. So I'm not really interested in buying a 4.7 cap and financing at 5.5. That's not that exciting.
Hi, Adam Gower here, host of the Real Estate Reality Show on YouTube and on good podcasts everywhere, and founder of Gower Crowd. Welcome to today's episode. And it is my enormous pleasure to introduce you today to David Scherer, who is co-founder and co-CEO of the gold standard of real estate syndicators or multifamily syndicators in the country, Origin Investments. And with full disclosure, I am actually a very modest investor with them also. Now, the reason that I asked David to join me today was that they have developed this tool. It's called Multilytics, that gives incredibly detailed predictive rent growth data to Origin Investments internally to enable them to decide where they're going to invest and how they're going to invest nationwide. The accuracy of this tool that they have developed internally, you're going to hear all about it today. It's really mind-blowing what they've done. They've got some rocket scientists over there. But the accuracy of their predictive ability, of Multilytics' predictive abilities, is really extraordinary, as you'll hear from David today, and how they have determined how accurate it is, right? By looking backwards at their predictions and determining how accurate they were. Well, Origin Investments have grown from much, much smaller. When I first met them about 5-6 years ago, spoke to Michael Episcope, one of the other, co-founder and co-CEO. They now manage, I'm not sure exactly how much actually, but David does talk about 5 billion of assets. Really incredible company, incredible growth story. You're going to find the story of Multilytics very interesting. And on the podcast page at gowercrowd.com, I will include a link to their latest Multilytics report. It looks at predictions for rent growth nationwide and also in some specific markets. I'm afraid you will not be able to plug in the address of any of your properties in the same way as David and the team there at Origin can, but you will be able to see city on city level detail and where rent growth is going to be the highest and where rent declines are going to be the highest as well. So I'll include that on the podcast page for today's episode, all there at gowercrowd.com. And of course, while you're there, if you're not already subscribed to the Gower Crowd newsletter, please do so. It comes out every Wednesday, and we cover the world of real estate syndication and crowdfunding, totally free. So sign up there at gowercrowd.com. All right, let's get on with it. My great pleasure to introduce you now, or to invite you to meet David Scherer, co-founder and co-CEO at Origin Investments. David, what a pleasure to meet you. Thank you so much for joining me on the podcast today. I've had the pleasure of talking to Michael in the past, so it's a delight to meet you as well. The other half, the better half, I'm not sure, of Origin Investments. That's what they say. But what I wanted to talk to you about is Multilytics and this new platform, or this new data analytics platform that you put together. It is utterly fascinating. 1 billion pieces of data that you analyze. So what is it exactly, David? Tell me, what is it? What are those data sets and how does it work?
Well, first of all, Adam, thank you so much for having me on. Michael spoke very highly of you, and Melissa, also our head of marketing, appeared on your podcast many years ago. So it's good to finally meet you in person, and look forward to the conversation. Multilytics, before I get into sort of the granular, I think we should start with the pain point that it was solving for. And what I do at Origin, my partner Michael Episcope and I founded the firm in '07, and when you have equal co-founders and co-CEOs, it's really important to have clearly delineated roles and functions. And so what I do is oversee what I would characterize as product, which would mean, in our world, acquisitions, analysis, and execution of business plans. So in my world, there's about 30 professionals that are throughout the regions we cover, which is essentially the Sun Belt states, Southeast, Southwest Texas. And what we're looking for are interesting deals and development sites within multifamily. We build, we operate, we lend. It's all multi. Now, the pain point. In any model, because a lot of what we do here is we're looking at hundreds and even thousands of deals, and we're trying to find the ones that we want to pursue. In any model, whether it's a leveraged buyout or it's real estate or it's venture, I think anyone who's trained in valuation and finance would tell you the most important variable. I'm going to put you on the spot. What's the most important variable in any pro forma model? Adam?
The rental income, presumably.
100%, but it's growth.
Growth, yeah, right. Trends,
growth is what drives any model, and if you have a high enough growth rate, any model looks good, right? So you need to have defensible growth rates, and in multifamily, that growth is rents. That's revenue growth, it's rent growth. And so at the time, this is 3.5 years ago now, we were using a licensed product, and I won't name it because I don't want to do that, but it's a widely distributed product you can license. And we had 3 pain points with the product. The first was it wasn't very accurate at predicting rents. So that's kind of a big deal, right? When they're predicting rents and it's not even close to what's happening.
Right.
The second pain point was it was nowhere near granular enough. So they would go down, and still do to this day, they go down to the zip code level. Zip codes are enormous, especially in suburban markets. And so you're talking about rent growth in a 10, 15 mile area, or in a city. I'll just name Chicago, for example. The same zip code as Fulton Market, that's the hottest area of Chicago, or west of the United Center, which is a very rough area. It's the same zip code. So it wasn't granular enough. And then the last thing that we really had struggled with is they're constantly changing their predictions. And so, I remember I just threw my hands up. Our Dallas office was pursuing a deal in Fort Worth. And Fort Worth, we're using, again, their predictive analytics that we were licensing from them. They were predicting 3.5% rent growth in Fort Worth. And we're pursuing deals, and then overnight they changed all those predictions to 1%. Well, no deal makes sense at 1% growth. And so what do? Are you done looking at Fort Worth because they arbitrarily changed their growth rate from 3 to 1? And by the way, then growth wound up being 6. Right? So it's not like they changed it from 3 to 1 and it was 0. It was actually widely wrong. So we just threw our hands up and said, look, we're not going to do this anymore. It's not granular. They change this constantly, and it's not accurate in its predictions. And I would add, they never held themselves accountable. They would never say, hey, in this city and these submarkets, we predicted these rents and this is what happened. They never publish anything. So there's no accountability. And so what we did is we said, look, we're going to build our own. And we set out to build our own predictive analytics. And in the beginning, we didn't even really know what we were trying to build. But luckily, and this is, sometimes in business, you get a little bit lucky too. The central place for machine learning, which can be applied to real estate, but really it hasn't been up until now, meaning we have, this is University of Chicago, and we're based in Chicago. And so we had all of this connectivity for students who were, brilliant students who were being trained by the leading minds in what we call spatial analytics and machine learning spatial analytics. And so we started hiring these amazing students. And so, now it's 3.5 years later. It took a long time because the key to building any model is, yes, you have brilliant young minds who can code in many languages and understand the data science part, but they have to be taught by our professionals what makes a good deal in real estate. Why would a neighborhood gentrify? Why, what makes you skate to where the puck will be, right? And that's really, if you think about a deal officer, that's something that officer has accumulated over 10, 20, 30 years. Right. It's a feel, it's based on data, but it's also a feel based on wisdom and experience. And so we spent the first year training these brilliant minds in what makes a good real estate deal. And we started in Denver. In our Denver office, Tom Briney leads it. He's been with us 12 years. He came over from Blackstone in 2011. He really went deep with them and said, okay, look, not only am I going to train you, I'm going to take you through all the submarkets. And by the way, I'll get into the differentials of what we do. But one of them is it's much granular than what we've been doing before. But he would take them through and say, look, this deal, this address, I think will outperform, and these are the reasons why. And then we build from the ground up. And with machine learning, it's a rules-based system ultimately, but you're feeding it data. And the key to machine learning is you're not constantly going in and tweaking it. That makes it an algorithm. You're getting out of the way so it can be unbiased and learn, right? And that's fundamentally what our model does. And you mentioned before, Adam, a billion, but the reality is we take in over 3 billion pieces of data a month. And it in an unbiased fashion is predictive about rents, not at a zip code level, but at an address level. So anywhere in the country today, if you said, hey, I'm looking at this building or this development in New York, what do you think starting rent should be and where's rent growth in year 1, 2, 3, 4, 5? That's what it does.
And that's absolutely fascinating. So the idea is that with machine learning not being an algorithm, it's not static. It's looking back on its own analytics, presumably then looking at actual results in the field and learning from that and constantly evolving. That's basically the definition of machine learning?
Yeah, it is. And the other thing is it's not a model. It's actually it's a series. It's thousands of models. It's actually, the first thing it does when you give it a problem is it's figuring out which models to use to solve the problem most accurately. So it requires a lot of computing power. But look, here's kind of where the rubber meets the road. And this is, I'm not on the podcast because I want to license. I don't. This is it doesn't make decisions for us, but it's a huge input into every decision we make now, whether it's to start a development, to acquire a building, to hold an asset, to sell an asset. We're also very involved in lending now to multifamily, whether it's buying bond positions from Freddie Mac or issuing our own loans. It gives us the ability to sift through hundreds and hundreds of loans in minutes and identify what the red flags could be, right? So I'll give you an example. Freddie Mac sent us a bond, new issuance, a couple months ago now, 2 months ago. It had 357 loans. We were able to price the bond and underwrite the bond faster than anyone, including a lot of shops. I won't name them, but you've heard of. And we were able to give pricing and feedback to Freddie Mac about which loans we believe are the riskiest in the bond pool. And they appreciate that. They appreciate both the feedback and the pricing, but how are we able to do that quickly? Well, because Multilytics is able to overlay what it sees. And it's not just rent growth, but it's also all of the demographics associated with that address. And we then take that and maybe there was 25 loans that it identifies, and then a human goes very much deeper on those loans, right? But we're not having to go through 357 because 357, 330 of them actually aren't flat, right? They're okay relative, and it's a little bit more complicated than that because you have to interlay debt service and LTV levels. But again, growth really matters, is my point.
Yeah, I remember during the last downturn, the global financial crisis, actually right around when the time when you started Origin, I worked for Colony Capital for a while over there, and they had been buying large portfolios of non-performing loans from the FDIC. And I remember the data that came in on these loans were Excel spreadsheets, actually, hundreds and hundreds of lines with all the loans listed and dozens upon dozens of columns with data points in it. And those loans had been underwritten manually, as far as I know. They had gone to a shop that had underwritten them and determined what kind of value could be placed on them. So my question to you is, what are the data inputs? Any machine is, whatever a machine puts out is dependent on what goes into it. So what are those data inputs? If you give them some ideas of the kind of data that comes in and what formats it comes in to give the results that you have. And then we stop talking about getting too much into the weeds and talk about some of the results that you're seeing.
Sure. So of the 3 billion, obviously a lot of the data is just going to be where rents are across the country. And what's really interesting is all this data, most of it, I should say, can be scraped. And so part of our coding is web scraping coding, where we're able to bring in rents from, hundreds of thousands or more units all the time, right? So that's part of it. The other part of it is publicly available information. Like there's a massive data trove in every census set, right? And so in the census, it was delayed this time because of COVID, but when that comes out, massive amount of data. And then there's, I can't speak to all of our data sets. Some of them are proprietary, but the point is a lot of the data that we have is free and available. It's about organization and access to that data. And there's work to be done to do that and replicate that. It's not impossible. We've done it, so other people can do it too. Where the real value is probably isn't even in the data set. It's in the machine learning and the AI's ability to process information and come to conclusions that are accurate, right? You can have the greatest data set in the world, and I can name some sources that have the best data, but they don't know how to organize the data in a way to come up with the proper renditions. Part of that is classic regression. So when you're looking at any model, you don't want to have 100 different variables in a model. It actually muddles the model. That's a misnomer. So what you want to figure out is what are the largest influences on the output of the model. And we found, and I can share this, that for us, units per capita is the most predictive element of future rent growth or non-growth. And that shouldn't be surprising. There's nothing profound about what I said. So units per capita means how much supply, how many units is coming to a market relative to the demand segment, which would be defined as people moving to the area or forming households and needing rental housing, right? So, if you were an economics student, you would say, duh, right? Like, of course, that's what it is. But there's an awful lot of thought and code that has to go into defining that. So you might say, well, how would you know what future supply is? Well, you actually know more than you think. You just have to be innovative about trying to figure out how to figure out what that means. How do you know what future demand is? It's complicated, but you might know more than you think. So I can't tell you everything, but I can
Well,
kind
I
of
was rather hoping that you might actually. So I was thought you might share all the secrets. But I know you could. Now you're talking about predictability. Now, predictability is something. Whenever I ask somebody on the podcast to make a prediction, nobody likes to do that, right? So you're either right or you're wrong. But you have actually looked back at your predictions, haven't you? And determined the degree of accuracy that Multilytics has. So why don't you tell me a little about that? I do know that I'm going to quote you over here, the industry leader data provider had only a 4% accuracy rate. How's Multilytics performing and how do you know?
Yes. So Adam, the thing is, I mentioned the 3 pain points before, but the one that probably bothered me the most was the lack of accountability. They never told you how predictive they were. They're constantly changing their predictions they might change them 3 times in a year. So it becomes very muddled. So with ours, number one, our predictions are made the first day of the year and we don't change them. And so what we do with all of our competitors is we constantly write down their predictions because they actually don't publish them. They'll give them to you in a moment in time, but you have to sort of track it via a spreadsheet. Does that make sense? And so we're writing down theirs and they're changing constantly, but ours is January 1st, we make a prediction. And so back to the accuracy, when we're comparing our accuracy to any of our competitors, we actually have to increase the geography of what we're doing because remember, we go to the address level. No one else does. So if that's
actually, I just have to say something. That is mind blowing that you can do that on
right?
a specific, like out of control.
So when we're comparing our results to someone else's, we actually have to expand our geography so it's larger, so it can be apples to apples. And in doing that, we actually become less accurate because we're most accurate at the address level, then the submarket level, then the city level, et cetera. As you drill down, we get more and more accurate. And that's an interesting part of the model. But I'll tell you a story because this is both recent and I think it's pretty fascinating. So, like I said, we spent a year building this and then they finally started getting to the point where they could make predictions. And so that was actually Q1 of 2021. And so Q1 of 2021, the data science team, the machine is now built and it's making predictions, right? And I don't hear anything about it. And now it's March, and now it's April, and now it's May, and like, what's going on? Like, where are the predictions? And what had happened was the model was predicting, for example, in Austin or Phoenix. I'll pick Phoenix. At the submarket level, where it wound up being most accurate, it was wildly more accurate than anything else in the market. But at the submarket level, it was predicting between 25 and 35% rent growth in Phoenix, which is absurd.
Right?
It's absurd. And so what had happened was, it's January, it's February. They're getting this back. They don't want to share it with me. Nobody wants to show it to me because historical rent growth is 3% for the last 100 years. And if it's not 3, it's 2. And if it's not 2, it's 3.5. They just built a machine and it's spitting out 30. And they think it's wrong. And no one wants to show it to me. Well, guess what? It wasn't wrong. It was dead right. And that was when my eyes really opened. Now it's the summer 21. The first thing I said to him, I was like, it would have been nice if you'd show me this. Because I literally didn't see it. And, we have the market leader was predicting 2 to 3% rent growth, and we're predicting 30. So, let's just start with that. We were dead right. Then in 22, we published, again, it's the first of the year. We're not, a lot of people publish at halftime. You have a 30-point lead and they say we're going to win. That's ridiculous, right? It's January 1st of 22. Our predictions were, I'll make it very, very broad. Each city's different. Each submarket's different. But broadly, very strong rent growth in the first 2 quarters. and flattening rent growth into the last 2 quarters, and then negative rent growth in 23. All of that has played out. Like it has been so right in 21, 22, 23. Yeah, I'm listening. Like I pay very close attention to it now because it's been so accurate. I'd be foolish not to.
Yeah, it is fascinating. And you also have a report on, I'm going to put it on the podcast page on the website. You posted it on LinkedIn, so I presume it's okay that I can
absolutely
replicate it on the website. It is absorbing. It's fascinating to look at, but there's more to it. And by the way, stop me whenever you're ready, because I could definitely keep on going, David. Seriously, it's absolutely fascinating. I've got a list of questions that I want to ask you, not just about Multilytics, but kind of in general about multifamily. Okay. So you just let me know when we're at the end of the time. But
of course,
there's more to it than just data. So you can look at a building in Phoenix or anywhere in the country. You can predict using Multilytics and then some human input as well. You can predict what the rent growth should be if the data is to be believed, what it should be. But there's more to it. It's not that rent growth is not going to happen just because Multilytics said it would happen. It's going to happen because of management. So how do you now assess when you're investing with a sponsor or you're investing yourself? How do you assess that component of reaching those rent growth targets? And just taking that one step further, presumably you can also target to exceed those expectations. How do you do that? How important is management now?
Well, management is critical, but you're honing in on a really important point. So the way that we look at it, because that's a variable that's very muddy, right? That's very hard to put your fingers on. So I would approach it a little differently and say, look, in terms of management, we've been in multifamily now for 14 years. Prequin, which sorts managers by strategy and vintage, and is it perfect? I don't know, but that's how we grade ourselves out. Mm-hmm. And we've been top decile for 7 years in a row. So like I know that we're a good manager. So I also know that won't be the variable, right? So what will be the variable is there's alpha and beta. Like alpha is the management. That's what you're honing in on. Like, can you add value at the management level to drive revenue, to decrease costs but not decrease value? Can you hire and retain the best people, et cetera, et cetera? Mm-hmm. I believe we do that. And so now I'm left with beta. And what machine learning is really honing in on is beta. Like I'll give you a great example. We haven't bought a building, by the way, in 3.5 years. That's a pretty bold statement. We're a real estate firm, with $5 billion of assets. I haven't bought a building in 3.5 years. I'm like, wow. Why? Well, because we thought valuations were too high and not sustainable. Am I ready to start buying now? Not really. I think it's getting closer, but I literally had a lunch today and someone said, well, are you ready to buy? And I said, not yet. I mean, leverage is negative. So I'm not really interested in buying a 4.7 cap and financing at 5.5. That's not that exciting. Replacement costs has moved. That's good, right? It used to be in 21, people were paying 20, 30, 40% above replacement costs. That makes no sense. Like that's a prescription to lose money. And so now that people have lost money, like I'd like to be run over by the train I can't see. Right? Like if you're paying 30% of replacement costs, like isn't that a train you see? Like that's one you should step out of the way of, probably, right? But here's my point. Good management teams will give you alpha, both in decision making, risk management, and you're mentioning operations. That's part of it, but it's only part of it, right? There's more. what I'm really interested in with machine learning and multilytics is beta. So 3.5 years ago, we bought 2 buildings. One was in the West Loop of Chicago. One was in Round Rock, Austin. Okay, both deals, I believe we got edge on the buy. So let's say we bought it 5% below the market. Both deals had good management. Okay, same company, fine. Mm-hmm. So now it's 3.5 years later. The equity in the Austin building is up 250%. The equity in Chicago is up 60%. Do you understand my point?
Yes. That's
beta. Mm-hmm. It's rent growth. It's beta, right? Like you had the same alpha on both sides, but Chicago just didn't grow like Round Rock, not even close. Mm-hmm. So if you're a long-term holder of multifamily assets like we are, we're generally not a merchant strategy where you build and get out, right? Because we don't think that's tax efficient. We believe in multifamily long-term as a protector and grower of value. We believe it's a necessity that people have shelter. And we believe that we're generally underhoused in the US. So we want to own the asset. But if I stick a growth rate of Austin at 4.5 and compare it to Chicago at 1.3, and now you take it out 7 years, I mean, take a look at those 2 models, what happens? I mean, it's pretty remarkable. So I'm being long-winded here, but my point is, don't ever underestimate the value of beta over time. Like, you need to be right.
So this example that you gave was 3.5 years ago. So this predates Multilytics. Would you have made a different decision, do you think, if you'd have had Multilytics and had been accurate in those predictions when you decided to make the acquisitions that you did?
Maybe. We've always underweighted Chicago investment, even though we're a Chicago-based firm. I mean, if I look across 14 years, we probably acquired or built 5 assets out of 100 in Chicago, which is pretty remarkably little. That was based on feel, you're right. And to some extent, algorithms we built. But yeah, I think that if we had had Multilytics 3.5 years ago, there's a reasonable chance we wouldn't have made that investment. And it would have been a great choice. Not that the investment hasn't done well, it has. But the opportunity cost was not doing another deal that did 150, on equity, not 60. So I'm not suggesting we probably made a mistake there, right?
Well, you still made money on it, though. It could be a lot worse, right?
Sure, but we're paid to find the best investments for people, both in terms of risk and return. And so, it was a miss, really. And people, you can rationalize it. Oh, you were diversified, whatever. But what I say, and let's go back to rent growth. If you didn't have a Multilytics, in my opinion, what you should use, just use the historical rent growth rate of the last 100 years, which is 3. And use it in every model. You'll be consistent. You'll never be right, but that is the historical rent growth rate. And if you hold it for periods of time, it'll probably start to, look like that. That's better than the alternative, which I see as the capricious models that you pay too much for and they're not accountable. And to me, that's worse.
David, let me wrap up with 2 questions, if you don't mind. Both the same, but about different things. First of all, so date stamping this conversation, July 2023. Where are we headed? Where are the multifamily markets headed? What does Origin see is going to be happening with multifamily over the next 6 to 18 months?
Yeah, and I'm glad I'm on a podcast, so I'm absolutely accountable. Although I will tell you, we started talking about this in Q4 of last year. So we were the first to come out and say this. Now there's a lot more people that are moving into our predictive area. But at the time in November, when we first said this, and then I wrote an article in December where I said it again, we believe there's going to be negative rent growth across the country this year. And so when I say that, then people say, well, no, but not Nashville. No, Nashville, negative, meaning lower rents than the year before. Or, hey, do you mean effective? Do you mean gross? I mean, if you're a landlord and you're giving concessions and rents and you put it all into a little bucket, you have less money than you did a year ago. Okay? Less revenue. And I think it's going to extend into Q1, Q2 of 24. And then what you're going to see is the long-term housing fundamentals are really strong. We're underhoused. And the metaphor I make is right now, we're a snake eating an elephant. So what do I mean by that? Well, the elephant is the amount of supply that's hitting the market in the next 12 months. Why is so much supply hitting the market? Well, because interest rates were zero in 2020 and 2021. I'm not casting dispersions at the Fed. There was a pandemic, but like they were zero. And everyone could borrow cheap, and too much was built. And how long does it take to build? Depends on the type of construction, but I don't know, 2, 3, 4 years. Well, guess we're 3 years later. Here we are. Like we're right here, and all supply's coming. Mm-hmm. That's the elephant. Mm-hmm. The snake has to eat the elephant. The snakes can be really full. Okay, there's not enough demand to meet the short-term supply. Rents will be stagnant and negative for a period of time. The interesting thing is, in a couple months, this is the metaphor, but let's say it's a couple years, now it's 25, right? The snake's hungry again. It wasn't hungry. It had to digest the elephant, right? But now it's hungry again. There's no next elephant. Now there's nothing. And the snake's wondering, like, where the hell's the next elephant? There is no next elephant. We're underhoused. And here's another thing. Nothing is getting built right now on the rental side. On the for sale side, sure, like there's still stuff happening. Look at, you don't have to go further than the loan volume. Look at the loan volume in multifamily. It's 50% lower than it was last year.
It's dropped off the cliff. But hang on, I do have to jump in there, and I don't want to extend too much longer, just out of respect for your time. But don't we have, just to contradict what you said, but don't we have apartment deliveries at a level not seen since the 70s? Isn't that going to eat up some of that demand?
That's the snake eating the elephant. I mean, there's record levels of delivery because there were so many starts in 2020 and 2021. But look past that. What about 25? What about 26? What about 27? I can tell you, because we're one of the largest developers in our markets in the country. We have 14,000 units in development, right? So that's a lot of units. I mean, you're talking about $4 billion of real estate, right? So believe me, me and our teams, we're very in tune with what's going on in development. It's been almost impossible to get new developments capitalized from Q4 on. So Q4 of 2022, Q1, it almost, there was a couple green shoots, and then SVB Bank happened, right? And now all of a sudden, all of your traditional lenders to construction, which are the regional banks, are wondering if they're going to be insolvent. They'll be the next bank failure. And so you've seen almost no lending to new multifamily construction from late Q1 on. So now it's Q4, Q1, there's a little bit of activity. Then SVB happens, nothing happens. You lose Q2. I think we're going to lose Q3. My point is, we're shaping up to have a supply delivery in 3 years that's unbelievably low. Right? You got to look 3 years out. So it's 23. What's supply in 26 going to be? It's going to be a pretty small elephant, my friend.
That's what happens. It's a step. That's what happens. Supply. Exactly. Supply is a step. It's a step. It's what happens. Like these periods of absolute nothing, and then a sudden explosion.
You have to look out over time. And so let me tell you the silver lining. Yes, we were the first to say that rents would be negative this year. it appears that's going to be correct. A lot of people are now coming to our conclusion, but it's July. I mean, it's a little late to talk about 23, isn't it?
Right.
But I will tell you that moving into 24, summer 24 and beyond, you're going to see it turn around because the supply is going to work its way through, and the long-term fundamentals are quite strong. So that's our opinion, is that rents move back to positive starting in sort of Q2 24, and they're quite positive in 25 and 26. And that shouldn't surprise you based on what we're talking about with supply.
All right, so let me wrap up with one final question. So when I did speak to Michael, however many years ago it was right at the beginning, but I can't tell you the date, but I can tell you that, as I recall, he said we have 500 investors and we want 10,000. I think you were doing primarily value add. So it might be 5 years ago, David, seriously, that I spoke to him. All right, so where are you? And where is Origin headed over the next few years? What are your goals and ambitions for the next few years?
Well, the interesting thing is the bigger we get, the more we hone in on multifamily. We just want to go deeper and deeper and get better and better at one thing. So that won't change. We have no interest in adding other real estate asset classes. Not that they're not viable. It's just we think multifamily is a huge asset class and has tremendous opportunity. And it's proven to be the highest returning, lowest risk asset class in real estate for a long period of time. That's really unique. I mean, think about that. How can you be the lowest risk and highest return? I would tell you because it's an essential consumption. You know, when a recession hits, you don't have to go on a business trip. You don't have to go to the office, but you do need a place to live. Like that doesn't change. I also don't think it can be disrupted by technology. I think every other asset class can, including the ones that you think correlate. So, okay, cell towers, they really correlate. Well, what if technology comes out that renders cell towers useless? And is that so crazy? Now you own a bunch of steel, you own scrap, right? So I don't know how to quantify that. So I don't want to be in it, right? Same with data centers. Data centers are wonderful. But last time I checked, the phone I have has more computing power than the first IBM computer. So what if someone figures out a way that uses less electricity and power to store data? Then what? Now you own a building at 2,000 square that's worth 20. That's a big loss, right? Anyway, to answer your question about investors, we have just over 3,600 investment partners at this point. Probably and by the way, we're 100% focused on taxable investors. And so everything we do is to protect, grow, and then minimize taxes for ourselves and our investment partners because we're taxed. You know, Michael and I still are our largest investors. That might not be true forever, but I can still say today that's true. And people take comfort in that, you know, we actually create funds and products and invest alongside you. And, you know, we obviously believe in what we're doing. And we're also taxed. So everything we do, you know, why are we in qualified opportunity zone funds so heavily? Because it's wonderful tax benefits for the taxed investor, right? Why do we have subsidiary REITs? Because they block dividends 20% for the taxed investor, right? But if you're a pension, that's just an expense. You don't have to pay taxes anyway, right? So we really don't try to mix investors. We want to have one type. And that's 3,600 tax investors, family offices, high net worth. Increasingly, I think we have 81 investment advisory firm partners. So, you know, that's, again, it's a relationship with the individual investor, but via their investment professional. So we welcome those relationships too. I don't know if that answers your question.
It certainly does, yes. And thank you.
We're not at 10,000. I'll tell you that. I'm not suggesting that. Yeah.
I did rather think it was quite ambitious, but I don't.
I'm gonna call Michael and tell him he's got some work to do.
But I do think that the results of Origin do speak for themselves. All right, so the impact that you've had on the results far outweighs the predictions that Michael had wanted that long ago. David Scherer, that's how your last name's pronounced. Scherer?
Oh, you nailed it. It's Scherer. Yes.
Yeah. Yes. Well, enormous pleasure. And I must say, I consider Origin Investments the gold standard.
Well, thank you so much, Adam. That means a lot. And, Michael, as we were talking before, he just speaks really highly of you. And I'm very discerning about podcasts and he said, look, no, Adam's incredibly smart. He has an amazing presence in podcasts, and this is time well spent. So you were very well regarded at Origin as well.
No, David, please, don't stop.
Thanks
for joining me. Real pleasure.
Have a great day.
That was David Scherer at Origin Investments, co-CEO and co-founder. What a story. I mean, these guys are really incredible. Right. So if you want to know more about David, go to the podcast page at gowercrowd.com. I will include a link to their latest report, or the Multilytics latest report. It does make for excellent reading. While you're there at gowercrowd.com, if you've not already signed up to our newsletter, do please do that. It comes out every Wednesday. We cover the world of real estate, syndication, and crowdfunding in detail with commentary and links and all kinds of good stuff, totally free. So do that at gowercrowd.com. And of course, got to ask you this. This show is on YouTube. So if you're watching it on YouTube, and even if you're not watching it on YouTube, please go to YouTube. It's youtube.com/gowercrowd and leave a comment. I would be more than happy to respond to you over there. That's it for today, David. What a pleasure meeting you. Thank you so much for joining me. We spent a lot more time, I know, today than you had budgeted for. I really appreciate it. It was an enormous pleasure meeting you. Thanks for joining me. And thank you to dear viewers for spending your time with us today. I hope you found it as fascinating and inspirational, actually, today's episode, as I did. That's all I've got for this week's episode. To finish up the sentence. That's all I've got this week. Thanks so much for joining me. For now, this is Adam Gower signing off.